Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Think about it, the meme stock phenomenon sort of died out in most of 2022 and a good portion of 2023 because we didn't have the euphoria across the board that we have now. Individual investors are back. In general, that's a very good thing, although I'd rather they focus on more, shall we say, value-oriented types of names.
There's no question that people can make money in these stocks because they're moving so much in a short period of time. The question really is, are they prepared to take the risks of losing a significant amount of principal in the case that the volatility turns against them? And that's what we've seen time after time.
In this AI battle, this AI competition between AMD and NVIDIA, what we're seeing is something that has never been done before at the data center level. They're basically going to be releasing these every year. Previously cyclical companies are becoming more secular. And then when you add on the software layer, that's really going to drive home secular gains.
We've got 1 hour to go until the market close, so let's take a look at the major averages. Pretty busy day for a Monday here. The Dow right now selling off about 217 points, but it's really a mixed picture that we're looking at today. So you have the Dow lower, you have the S&P lower by about 1/5 of 1%, but you have the Nasdaq higher by 1/10 of 1%. So let's break that down, shall we? We had manufacturing data coming in today worse than estimated, and so that then is having a ripple effect in the bond market, and then that's what you see playing out with the Dow and the S&P today. So it is sending yields lower actually by 1/10 of 1%. And this is something that sort of cuts both ways, because on the one hand, maybe we'll allow the Federal Reserve to cut rates sooner than expected, perhaps if we see some slowing in the economy that brings down the pace of inflation. However, if they're slowing in the economy, that's not necessarily good news for the economy itself and for earnings. So that's kind of the elements that investors are weighing today. When it comes to the NASDAQ, we see that increase due to what we're seeing play out with chips here today. But let's get to what's going on with the memes there. We just heard some folks alluding to what's happening with meme stocks in today's session. If you look at them sort of very broadly here, you see a mixed picture, but you got to equal weight it to kind of see what's going on here, because guess what? There is GameStop up in the corner. We're going to get to more on that as the show goes on. There's the 5-day to really give you a look at the big jump that we saw in the shares, and that has to do with the man known as Roaring Kitty, or at least someone purporting to be him, revealing a big new trade in that name. AMC also getting caught in that updraft. What we just also talked about what's going on with semiconductors, a quick look there with NVIDIA leading the way higher as the Computex conference is happening in Taiwan. Jensen Huang of NVIDIA, Lisa Su of AMD, some of the folks who were speaking at or around that conference. We also got some announcements from Intel, and maybe we'll get some more. So all of that affecting what's going on in the chip space today. Josh?
All right, Julie. Meme stocks starting the first trading day of June back in the spotlight. GameStop getting a lift after individual investor Keith Gill, also known as Roaring Kitty, of course, revealing a nearly $175 million position in the video game retailer. This coming after a short-lived rally in GameStop last month, leading to the company selling 45 million shares. For more on where the meme trade is headed, let's get to Chris Murphy, Susquehanna International Group, co-head of derivative strategy. Chris, it is always good to have you on the show. So let's dig into this, Chris. So Roaring Kitty, I'm just looking at his position here, Chris. 5 million shares, a bunch of call options expiring June 21st, strike price of 20, nearly 66 million worth of those. I mean, this does look like a meaningful position here, Chris. What do you make of it?
Well, yeah, it is a huge position for an individual. GameStop's trading so much volume. So in terms of if his position is going to impact GameStop itself, where it's trading and things like that, the actual trade, even if you were to close out of that position, really is not going to have a huge impact. It's more the sentiment that everyone's looking for. What is Roaring Kitty going to do next? And then his followers are going to follow that. And of course, the pile on of all the followers, now that could have a real impact on the stock.
And Chris, it's Julie here. Just put this into perspective for us. So according to this screenshot, and we got to caveat all of this, you know, the account says it belongs to this person who we've known as Keith Gill in the past. You know, it hasn't been verified. There's no one like, you know, that we know that has said, yes, this is mine. So just, that's the caveat here. However, it also looks like 120,000 options contracts are held as part of this trade that expire on June 21st. Give us sort of perspective on the size of that kind of options position relative to what we typically see.
It's a big position. It's a big position for GameStop. It's certainly a big position for an individual. But you know, GameStop will probably trade, you know, maybe 200 million shares today. So you know, that's the equivalent of 12 million. I'm sorry, it is a huge position, but like I said, it's such a liquid stock. It is trading so much that that impact of that trade, if it was an institutional client like we typically deal with, and they were closing out of their position, and we knew it was them and not some someone online, and we knew it was a focused trade versus the chance for a like amount of followers to follow on afterwards. That's really what's adding to the uncertainty here.
Chris, I'm just curious, when you look at this, you know, as someone who knows the market so well, do you have any kind of legal or regulatory questions, Chris, or no, you think, you know, the guy's a trader, he has the same information that everybody else does, that Chris and Josh do, and God bless?
I don't. Yeah, first of all, I wouldn't speak on anything legal-wise, but I would say that we track this trading for our clients, and when we see these large positions being built up, we are taking notice of them. So the information is there if you're looking at it. Like, you know, this tweet coming out yesterday or overnight or whatever it was, or the post on Reddit, that, you know, could have somewhat been expected if you are watching. GameStop was pretty quiet, after 2021 through 2022 and 23, and then all of a sudden, you know, a month or two ago, the options really start heating up again. There's no real story, there's no real event, so you can kind of see that information out there. You know, obviously, you know, we weren't expecting it to be a specific person, but you can see these trades. It's a listed market. Every option trade that trades is accounted for, and you can see it after the fact. So, that's why this trading options is challenging. But this information was out there in the world, just not who it was.
Well, Chris, so I guess my question is, back when this thing first started rearing its head in 2021, there was this whole narrative about the small retail investors versus the hedge funds, and then the hedge funds started participating on the side of the retail investors, you know, because whatever they would see that would make the money. So I'm just curious now, when you say you're monitoring this kind of activity for clients, are clients also participating in these kinds of trades? I mean, before we knew it was him, did you see other people trying to get in on that activity? And do you see that happening with some of the other so-called meme stocks also?
You know, it's like you guys kind of alluded to already. It's harder. It is hard to trade, and there was a guest in the snapshots before I came on talking about you have to be willing to, understand the losses as well. So, you know, I spend 99% of my time on other opportunities, on Fed events, on CPI, on things like that. I really only look at this when this stuff pops up, and it's typically more media related than our clients. Now that this move has happened, you have to keep in mind that the options are really, really expensive. So if you're late getting into the options and buying them and trying to hold them for any kind of a long-term period, that's very challenging. And in addition, dealing with institutional clients, they don't need me for GameStop. Like I said, it's incredibly liquid. You can trade options in and out all day long. You don't need an institutional broker for that. So really, we're more using it as a vehicle to field questions, to explain the risks of the options to our clients, and to help them to understand what's going on and whether it's impacting their portfolio or not. And typically it's not.
Chris, I'm just curious, more broadly, do you see this trend, this kind of meme stock phenomenon? Do you see it continuing, Chris? Because it didn't, I wouldn't say it died in 2022, but it did feel like it died down and now it's back. Do you expect it to kind of stay back?
Investors are smart. Investors are creative. When dislocations like this happen, people find ways to take advantage of it. And there's a lot of new call selling of high volatility stocks, and there's people that are providing that to clients now. So things never swing too far in one direction without a counterbalance. So I think that as we saw already, the meme stock movie from a week or so ago didn't last very long. And then you guys showed that graphic before you put me on showing the heat map, and it was just GameStop. I mean, the last one or two times around, people are looking for the next meme stock. It doesn't really seem like that's happening right now. It just seems like this is very situationally specific. Nobody wants to get on the other side of this, shorting it here, because Roaring Kitty did his Twitter post and he did his Reddit post, but he hasn't done his YouTube post yet. So everyone just wants to stay away from this one until it's completely played out. So short answer to your question is I think that it's in the later innings of the meme stock thing.
Chris Murphy, thanks for your perspective on this interesting stuff, and we're going to continue to watch it. And by the way, later we're going to talk to somebody who said he's shorting it. So we'll see how that is working out so far. Thank you. We're just getting started here on Market Domination. Coming up, paying up to dine out. We'll take a closer look at how the rising cost of food away from home is impacting fast casual stocks. Plus, as tech giants look to offset their AI emissions, we're focusing on the business of carbon removal in our latest episode of Next. You can tune in at 4:45 p.m. Eastern for that. Plus, Berkshire shares down 99%. No, not really. Blame a glitch at the New York Stock Exchange for misleading stats on some stocks today. Seems to be over now, but we'll have more from the NYSE floor next. Let's get to some trending tickers now. Investors starting the week with quite a curveball as the New York Stock Exchange said a technical issue was responsible for large fluctuations in the prices displayed for certain stocks, including Warren Buffett's Berkshire Hathaway. Here to help us explain what exactly happened, Yahoo Finance's Jared Blickery. People looking at BRK definitely had to do a double take today, Jared.
Yes, and I saw some articles from certain news organizations that had to be retracted. Berkshire Hathaway did not go 100% down today. I can verify that. But we do have a statement that we can attribute to a New York Stock Exchange spokesperson about the resolution of this issue. It says, after the market opened on the morning of June 3rd, that's today, technical issue involving industry-wide price bands published by the Consolidated Trade Association Securities Information Processor triggered limit up, limit down trading halts on up to 40 symbols on the NYSE group exchanges. And when we take a look at some of these symbols, and I have them in the Wi-Fi interactive, it's not exhaustive, but we have quite a few here. You can see Berkshire Hathaway, the A shares are front and center, and they are currently trading at $625,000, $662.50 per share, but that was not the price reported earlier. Some other big tickers affected: Abbott, Chipotle Mexican Grill, and we also have some smaller tickers as well, including GameStop up 30% today, and also AMC up about 13% today. And all of this comes on the heels of a new trading practice that was instituted last week, which is T+1 settlement, which means all the stocks are going to be settled in one day as opposed to 2 days previously. It's not known if this is in any way related to it, but within the last week, we've had a couple of trading glitches, and it's been supposed or proposed that maybe it is the issue. I dug around on the website for the NYSE, and I came across another statement here, and this kind of explains also what's going on. Today, between 9:30 a.m. and 10:27 a.m., CTA, that's the Consolidated Trade Authority, experienced an issue with limit up, limit down price bands that may have been related to a new software release. So just another one of those cases of new software release. They were able to fix the issue by failing over to a backup data center. But I guess the good news is that all of these stocks that we're looking at right here were not limit down at their lows today.
Jared Blickery, thank you. Appreciate it. Next up, Novavax shares soaring today. The Food and Drug Administration announcing it would vote whether to recommend a new COVID-19 booster. Here with more is Yahoo Finance's senior reporter, Anjali Khemlani.
That's right. And of course, Novavax, we know, one of the companies that looks to gain the most from this move from the FDA if they do decide to propose the JN1 variant as the strain that companies should focus on. That includes, of course, players Pfizer and Moderna. We know that those two will obviously also be out with their vaccines. And this is setting up to be not so much the strain that we need to focus on here in the U.S. KP2 is now overtaking JN1, and we are still keeping track of these strains, and they are all Omicron subvariants. So that is the one benefit, is that no matter what strain gets chosen by the FDA, they are all going to be able to offer some level of protection, barring any surprise. We know that that is the ongoing story for the COVID disease, that, you know, it has been evolving, continues to evolve and impact mildly most people who are protected. So what the fall rollout will look like and what the demand will look like still remains to be seen, but Novavax up because it will be able to play in this fall season.
Yeah, and as you said, Novavax looking to capitalize the most because it has the most to gain, because it's coming from, I mean, in other words, most of the other players are big companies, they have lots of other products. Yep. Not Novavax.
Well, and Moderna also,
Right.
Not so much with the other, it's still working on its other products. So it did also get its RSV vaccine out now, so it has two products. But yeah, Novavax still the one that has just a single product on the market, and that is this one right now. So it does stand to gain the most. I also actually spoke to someone about whether or not this really matters. What does the fall booster campaign really do for us? And he basically told me that, you know, if we're looking at boosting for the broader American population, we're all pretty solid right now. It doesn't quite matter. It's for those who are immune deficient in some way or need that support through what is known as memory cells. Their bodies cannot produce that protection that's needed. And so up until a random variant comes out that we have not seen before, we're all pretty good.
I'm looking for some wood
to knock on me too.
Here. Thanks, Anj. Appreciate it. And let's get to the final trending ticker that we're looking at. That's Paramount. Paramount Global and Skydance Media, they have agreed to terms on a complicated deal that would merge the two companies while keeping Paramount publicly traded. That's according to CNBC. Here with more, Yahoo Finance senior reporter Alexandra Canal. Allie, maybe this is coming to a close?
Yeah, you just knocked on wood. I'm going to knock on wood again because it feels like this months-long saga could potentially be reaching the finish line, but you never know here. We did see share surge as much as 9% on that CNBC report, but as you mentioned, ultimately this all comes down to Shari Redstone. A deal must first be approved by Redstone in order to move forward. Now, CNBC said we could see an announcement in the coming days, so that's something we're going to continue to track. And this is a very complicated deal. So I'm going to try my best to give the top level highlights based on some of these reports. Number one is that Shari Redstone will receive around $2 billion cash for her stake in National Amusements. Skydance would then merge its studio business with Paramount's and purchase about half of Paramount's non-voting shares for $4.5 billion. That translates to about $15 a share. Now, those non-voting shareholders will have the option to cash out about half of their stock at the $15 premium, with the remaining shares converted into shares of the newly merged company. And then finally, Skydance and its affiliates will also offer a cash injection of $1.5 billion to help pare down some of Paramount's debt. So this is a total deal that is valued at $8 billion. It was sweetened from that initial offering of around $5 billion. So it appears this is more attractive to shareholders. We do have that annual shareholder meeting for Paramount taking place tomorrow morning at 9 a.m. Eastern. It's not expected that we'll see the deal be announced then, but certainly at some point this week, it could be a possibility.
If they're not talking about it there, you have to wonder, what are they going to
I know, what else are they going to say at this meeting?
Yeah. Switching gears, Spotify, another price hike?
Another price hike, unfortunately. This was hinted throughout the last quarter in the earnings call. Prices are going to rise between $1 and $3 depending on the plan. Family plans, that's going to see the largest increase. Prices there rising to $19.99 a month, up from the prior $16.99. Those duo plans, that allows two users to share an account, that's going to be increasing by $2. And then Spotify premium subscriptions will now cost $11.99 a month. That's an increase of $1. Now, we saw Spotify boost the price of their offerings last summer. And like I said, they've been hinting at this. This is something that they've been committing to as they work to reach profitability, stronger margins. They spent a lot of money on podcasts. Now this is a consequence of that.
I still think it's a bargain.
Yeah, and that's what analysts say as well. There's a lot of bullishness on the street, and you'd have to think that a lot of these services were priced really low to start just to get those subscribers. Right. And now we're at a point where you're going to have to pay a little bit more.
All right, Ali, thank you. Appreciate it. Investors struggling to keep the market's May momentum going in the first trading day of June. Stocks mixed with about 30 minutes left to close. Weak manufacturing data this morning, yet another sign of an economic slowdown spooking some investors. But our next guest says there's an opportunity to trade the scare around slowing. With us now is Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, it's good to see you. So, all right, so we kick off June here, Brian. I thought it was interesting, Brian. CFRA's Sam Stovall, he had a note out this morning to his clients, and he was pointing out June, he said, you typically deliver below average returns and volatility. But Sam was telling his clients, listen, we could see some elevated volatility this June. What do you think? You think the chance here, any chance of a June swoon, Brian?
Yeah, I like that play on words there. And I think that there is a high likelihood that we will have that type of swoon, mainly driven by the resurgence of a growth scare. Now, we here at Annex on our investment committee think that it is just a scare, that this fear will not become a reality, but a lot of people are probably going to start talking about recession risks once again. We already had last week the personal consumption expenditure data come in. Real spending is negative in the month of April. Well, had a decline in real terms for disposable income. So the consumer is beginning to show signs of some fatigue. And then when you get to manufacturing, the ISM manufacturing number is going below 50 again. That's just another sign that manufacturing is really not making a good turn here. So it does point to, we think, slow growth ahead. Not negative growth, but definitely slower growth ahead.
And so why aren't you as worried then, I guess, about a recession risk here?
Yeah, I think the biggest reason why we're not worried about it is mainly because the consumer is still in a good position in terms of balance sheet health. We do know that tighter monetary see higher interest rates really affects individuals across the broad economy from the bottom up in terms of lower income individuals who are more heavily indebted, also have the higher interest costs, lower credit ratings. And so that's where you're seeing some signs of real pain. But the majority of consumers, so if you think about middle income and higher, they're likely just taking a little bit of a pause here, maybe doing a little penny pinching, not necessarily that they're going to batten down the hatches. So we think that we're actually moving to a slightly more sustainable pace of economic growth as opposed to the torrid that we somewhat became accustomed to last year.
For the stock market, Brian, as you look out now, at least near to intermediate term, what would be your big concerns, Brian? What's on your wall of worry when you're talking to clients?
Yeah, I think that as far as the wall of one of the biggest ones is really the auction anxiety coming back again. We saw as far as the Treasury auctioning off securities, those not necessarily being as well bid as they have been past. That's creating and contributing to interest rate volatility. And so that can create all sorts of turbulence on its own. And then we also have, I think, as far as the Fed, really, they're trying to figure out, is inflation going to cool faster than growth? Right now, it looks like growth might cool faster than inflation. And so will they need to now change their narrative? If they're going to dig in their and insist that they don't need to cut rates until maybe after the election, sometime in December, that's just going to continue to tighten the screws on small business, especially small cap value, which is the area where they tend to have the highest debt burden. So from a market perspective, we think that a Fed that is almost twiddling its thumbs or sitting on its hands is probably one of the biggest risks to the market right now.
Brian, great to see you. Thanks so much for your insight. Appreciate it.
Thank you.
Dining out, get ready to pay up. Food away from home is getting much more expensive than a meal at your kitchen table. More on what that means for fast casual names is coming up next. All right, well, now let's get to some calls of the day here. Loop Capital maintaining a hold rating on Tractor Supply, the price target of $250. You can see shares under some pressure there, Julie. This is coming from, of course, Anthony Chikumba. We like Anthony. We know Anthony. Smart guy. Looks like a couple of concerns for Anthony. One, he calls out this sort of widening pricing gap versus rivals, that it is on average 8.5% more expensive compared with 6.7% more expensive in March. And it sounds like what he's saying in and of itself, he wouldn't be terribly worked up about that, but given the move in stock, trading, he says, at a significant premium, you know what, given all that, he's still lukewarm.
Yes, and by the way, Tractor Supply, the stock chart over the past few years has been pretty, the 5-year chart I think is something like 150% gain. They've opened a lot of new locations during the pandemic. Everyone became a gardener, right, or moved to the suburbs. And I love looking at this price survey and the different items in it, from the Vapo rust remover to the loose fit mock neck vest to the commercial pro sprayer and various types of dog foods.
Sounds like a market domination field trip to track.
I mean,
I think is what
I
we
love
have
these.
to do.
I love these kinds of stores, but you know, you gotta know your customer. It was known sort of as a premium experience within this farm, gentleman farmer kind of cohort. But you know, in this environment, that's perhaps a little bit less tenable than it was for a while.
Bloomberg noting, by the way, the company is speaking at Baird's Tech and Services Conference tomorrow. So who knows? Maybe some more Tractor news at that point.
Yes, I look forward to it.
I will.
Let's talk about another retailer, Best Buy. It's getting a double upgrade from Citigroup, which also raised its price target from $67 to $100. And
a rare double upgrade.
A rare double upgrade. So that one really, you were very excited about that this morning, to see the rare double upgrade.
You've been in financial news.
Yeah,
just
for too long.
It's really, when you jump at a double upgrade.
Wow. So as the analyst says there, the thesis changer for this has to do with gross margin execution, that even if the company's same-store sales aren't going to be great, that they are still going to have building gross margins from here, and that's going to be kind of the pivot.
He acknowledged some risk, Julie, telling his clients, listen, I acknowledge second half same-store sales risk. He talked about basically broadly consumer uncertainty, but thinks it's prudent to look at the multi-year opportunity ahead as the business returns to growth and an attractive margin expansion story develops. Most on the street, by the way, do not share this bullishness. Most are on the sidelines, but not Citi. They are all in.
Yes, and they say eventually, as you're looking at that multi-year opportunity, eventually when rates come down, the durable goods demand should come back along with it, and that's something that Best Buy can benefit from. Maybe people will start buying laptops again, they say.
Who knows?
We'll see.
All right, let's move on. For some families, dining out is more expensive than ever. The problem, dinner at home is also pricier than it's ever been. And joining us now with more is Peter Galbo, Bank of America Securities Senior Food and Beverage Analyst. Peter, thanks for joining us. So the note here, Peter, says you say the gap in the cost of food at home versus food away from home is now at an all-time high. Just walk us through that trend, Peter. What are you seeing and what explains that?
Yeah, thanks, Josh and Julie, and good to be with both of you. Look, I think what we're seeing in the data is that, you know, the cost of food away from home, it typically is always rising. And so to say that on an absolute basis, you know, the cost of eating away from home is at an all-time high maybe isn't the more relevant topic. And the note, you know, the numbers we've laid out in the report emphasize that it's about $10 more expensive to eat away from home in a quick service or in a fast food setting, and about $25, $26 more in a more kind of sit down environment per person. I think what's more interesting, though, that we pointed out is that the relative gap, so on a percentage basis, is at an all-time high. And again, in that, you know, food quick service channel, it's almost 4 times more expensive, and in the sit down channel, about 6.5 times. So that's the more alarming piece that kind of we're calling out here. Now, what's interesting, Josh, that kind of you mentioned is we're starting to see a lot more promotional activity come out of the restaurants as a response. And my colleague Sarah Senator is our, you know, restaurants analyst. I can definitely let her, you know, speak to those trends more fervently. But it's notable that just given where the food companies are and they sell into all channels, kind of some of the trends that they're witnessing.
Well, and what's interesting to me is that you also point out, even as we see this price gap widen, that the food away from home stomach share, as you call it, or share of stomach, has still been increasing. And you know, everywhere we go right now, for the past month especially, we've seen an increasing drumbeat of concerns over price sensitivity, over consumer spending, right? And yet you see people eating out more. What is that about?
Yeah, Julie, I think it's a big question, and certainly something we even debate internally here around just the status of, you know, the lower income consumer and how that consumer is faring, particularly in that at-home channel. Why are they not able to or not purchasing nearly as much? While as, you know, the upper income consumer seems to still be doing okay, and they're driving probably more of that away from home spend at this point. I think what's particularly interesting, and we're going to see here, we have a couple of the off-calendar food companies reporting in the next few days. We've already gotten some commentary out of General Mills and out of Hormel that they're starting to see a need to kind of pick up promotional activity more so in the at-home channel. We're going to hear from Campbell's and Smucker's this week as well, and I'd expect that to be kind of more of the case.
And Peter, another name I want to get your take on, I know you're bullish on, is Lamb Weston French fries, Peter, right? Which is interesting because I remember, you know, when they last reported, Peter, I remember we talked about this on this show, and they reported, Peter, and they just got nailed. Walk us through what happened at that point, Peter, and why you're confident they've moved past it.
Sure. So look, I think a few things, right? You had the instance where the company was implementing a new enterprise resource planning system effectively across their entire North American network, had some hiccups that went along with that, and you know, had a volume disappointment in the quarter as a result. Volume disappointments in food companies are being punished pretty dramatically at this rate, and so I think that was a big driver of what we saw kind of coming out of the quarter. On top of that, you know, Lamb Weston was kind of the first ones to call out the softening environment that we've been seeing in restaurants. They reported it about a month before you started hearing out of, again, some of the restaurant names, whether it be a Darden or a McDonald's. And so what I think we've seen as a response from that point is, again, this promotional activity that has picked up. And what's important in that, Josh, is that fries are being included in the bundles.
Fries are being included in the bundles at these various fast food places in order to have sort of value meals, so to speak. I mean, what does this all say about pricing power or lack thereof of the food companies right now?
It's a great question, Julie. I mean, if you go back, and this is something we've looked at, you haven't had this level of pricing over a cumulative kind of 3-year period in the U.S. since like the 1970s. And that's really been, you know, the only historical example that we can really point to where you took this much pricing in a short amount of time. I think, you know, typically we would think about a low single-digit type price environment each year. We obviously saw north of 25% from the food companies between kind of 2021 and today. And so, look, I think there's probably a breather that all these companies need to take from a pricing standpoint, potentially even some rollback on pricing here in the next, you know, call it 6 to 12 months.
Another name I want your take on, Peter, Utz Brands, potato chips. Correct me if I'm wrong, Peter, but didn't you have a buy on that one as well?
That's right, Josh. We upgraded Utz back in March to buy.
Is that in part, Peter, walk me through that thesis. In part, is that because you see them as an acquisition target?
So that's not our primary rationale there, Josh, but really what we see is Utz as a distribution opportunity. So they have relatively low market share. Think about them more as a regional brand that kind of started in the mid-Atlantic. They're starting to gain distribution nationally. So that's not only throughout the Southeast where they've had some new wins with Publix, but some bigger pushes even into the West Coast. What's interesting is we think Utz has really been a share gainer at the expense of some of the other salty snack companies, particularly given they have, call it a 15 to 20% price discount on shelf relative to some of the peers.
And so is there anybody else that kind of stands out to you that's going to be able to benefit in this environment?
Yeah, it's been challenging for a lot of the food companies. Again, I think as we thought about, you know, lapping some of the downturn in SNAP allotments or the supplemental nutrition allotments, that there would be sort of a tailwind that would lift up a lot of these companies as we got through April and May. We haven't really seen that come through in the data yet. One name that we're still positive on and feel good as we get into the back half is McCormick. We like that they've kind of gone through the iteration of solving some of the price gaps they have relative to private label and some of the new innovation and distribution opportunities that they have in the second half, particularly as we get through kind of the summer grilling season.
Peter, thanks a lot. Appreciate it.
Thank you.
Coming up, happy first trading day of June to all who celebrate. We're taking a look at what's in store for the market in the month ahead and how to play it in your portfolio. Stay with us.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Over the weekend, OPEC Plus agreeing to extend most of its production cuts into 2025 in a move to support oil prices. Here with what else we heard from OPEC is Inez Ferre. Inez, big meeting over the weekend.
Yeah, big meeting over the weekend, and we didn't really see the full impact on the oil markets until this morning when you saw WTI and Brent go down more than 3%. And part of this is because of the details of that plan with their output cuts extending into 2025, because there are some voluntary additional cuts within that plan. Those will be phased out in the next 12 months, starting in October. And analysts told me that the markets really had anticipated that those cuts would be extended through the end of the year. So you have that 2.2 million barrel a day cuts that are voluntary additional cuts. Those are going to be started to be phased out on a monthly basis later this year. That's part of the reason why you saw that heavy selling. There were also some technical trades that were also creating pressure on oil prices and simply traders that weren't buying the dip. Now, if we take a look at our Wi-Fi Interactive, I just want to show you where we're at with oil prices. Year to date, we are seeing that WTI is up about 5%, off about 13% from its April peak. Brent crude also down more than 13% from its April peak, and year to date up 3%. As far as what this is doing to gasoline prices, this is sending gasoline prices lower. We have seen wholesale prices go lower. So we had some predictions that we would see a decline in these gasoline prices. But take a look there. You're looking at the average on a national level at 353. That's down from 367 a month ago. And it's actually down more than 5 cents from a week ago. That's the biggest weekly drop for 2024 that we have seen with gasoline prices, guys.
All right, Ez, thank you. Appreciate it.
Thank you.
All major averages notching a 6th positive month in the last 7 after closing out May with monthly gains and records. The S&P and Nasdaq both posting their best May performances since 2003. The Dow saw its best May since 2020. As investors kick off the new trading month, we're looking at how to navigate the big picture with the Yahoo Finance Playbook. Michael Sayers, Rockland Trust Vice President and Portfolio Manager, along with Jason Barcema, President and co-founder of Halo Investing, joining us now. Guys, it is good both to see you both here. Jason, I'll start with you. So, listen, we're kicking off June. I know, Jason, some strategists think could get kind of bumpy here in the near term, but let's get your take, Jason. What do you make of this market, where we are, and where you think we're headed?
Yeah, I think now that earnings are over, ultimately the market's going to be focused on the economics, right? And you're starting to see that in volatility both Friday and today. And clearly the last day of the trading month and the first day of the trading month don't tell a lot. But I think investors should brace for volatility as we look to the summer.
That seems to be kind of the conventional wisdom right now, Michael, that we're going to get this volatility coming. Do you think that the volatility is justified, or do you think some of the recent pessimism that seems to be creeping into the market recently is justified?
Yes, and thanks for having me, Julie. I've seen some headlines, too, about a little bit of a liquidity withdrawal in the month of June. And even though some people say, sell in May and go away, I think, the seasonal tailwinds typically actually go through July. So I'm not really too concerned about the summer or even through the end of the year. I think the economy has enough underlying momentum, and there's a lot of fiscal support from all the government spending such that we can make it through the end of the year without a significant deterioration in the economy.
Jason, let's get to some areas you like right now. One is utilities. How come, Jason, walk us through why you see opportunity there. Is that more defensive, or is it kind of a mix of defensive and offense that you're seeing as kind of a way to play that mega trend of AI?
It's a great question, Josh, and it's a mix of defense and offense, right? My favorite type of playbook. And ultimately with utilities, if the economy continues to soften, as we saw in some of the numbers last week, and of course this morning with PMI, utilities can be a great defensive play within portfolios. They're high dividend yielders. Those should look more attractive if the Fed, in fact, cuts interest rates this year. And who knows, my call is for one cut for the Fed this year. But I think it's about a global macro play, really talking about the offensive. There's such a strain on our grid system, thanks to obviously the AI boom, EVs, and ultimately just a robust economy. So I think utilities can be defensive within the portfolio, but also play that offense despite the rally we've already seen in the sector.
And Michael, I would call the picks that you sent to us defensive E, maybe, or, they're not necessarily big growth stocks, right? So let's I'm going to look at Honeywell for a minute here, because, an industrial has some cyclical characteristics, but how are you viewing it and where does it fit into your strategy?
Yeah, absolutely. So Honeywell is a high quality industrial conglomerate, although more recently has announced plans to refocus and it reorganized its business segments. And so, kind of looking forward, Honeywell is just very well positioned to benefit from the industrial renaissance that we're kind of seeing in the U.S. with a lot of the supply chains being moved back onshore. So that's a nice tailwind for them for their building automation, industrial automation, and also their renewables segment. And just in terms of them trying to play AI a little bit, they recently came out with Forge and rolled that out. So right now that's just available to their building automation segment customers, but that's a cloud-based software platform that's tailored to deliver customer-specific AI data insights. And so that's early days for that, but it's something that could be rolled out to the other customers in the other segments over time and be a nice tailwind for earnings.
And Jason, back to you, another sector I want your thoughts on. You like financials here. It sounds like, Jason, in part that's higher for longer backdrop. Also, though, you seem to suggest here, Jason, you think this is another sector that benefits from the AI rollout.
I do. I mean, you've heard Jamie Dimon talk about this at length, right? There's over 400 applications, within JP Morgan via AI. And ultimately, as Michael pointed out, right, we're in this industrial renaissance of AI. Now with financials, Josh, you have to pick your spots, right? Not every financial is created equal. I really think that the mega banks, as I say, the too big to save banks, are well positioned here because the smaller banks still have a lot of CRE exposure, commercial real estate exposure on their books, and that makes me a little bit nervous. But ultimately, what we're seeing, at least with our advisor clients at Halo, is we're seeing people being defensive. They want to play offense with protection, and you have to pick your spots. And by doing that with derivative-based products and protection, I think is the prudent way to do it heading into the summer.
So what do you mean by that exactly?
Yeah, it's a great question. So ultimately, just as you wouldn't drive a car without insurance, you shouldn't invest without insurance. So we're seeing record volumes with advisors buying structured notes that are linked to major indices like the S&P 500. Europe is really popular right now. Japan's really popular. And they want to go long the index, but they want to go long with a level of downside protection, not just in case their macro thesis of U.S. equities or international equities go wrong, but if one of these macro variables rears its ugly head. You have a multitude of elections, including one in this country coming up. You have the Fed, where we have no clue of what's going to happen this year. I have my own views, but Barron's doesn't think they're going to cut allegedly after their post this weekend. So you have a lot of macro boogeymen out there, but ultimately our clients still find a lot of attractive valuations in the market. They just want to dip in with protection in case, ultimately the market pulls back.
Michael, back to you. Another name I want your thoughts on. You say, telling viewers, you think APD is a buy. How come?
Sure. So Air Products, they're an industrial gas supplier. It's an oligopolistic industry, and there's only a few players around the globe. And one of their biggest competitors is Linde. Now, Linde over time has executed a lot better than Air Products, so they tend to get a premium. And Air Products has a little hair on it right now because they're embarking on some very large projects that they haven't done before, like green hydrogen products that really plays to the renewables angle. So there's some concern there that they won't be able to execute on time or on budget with those projects. But ultimately, we think those concerns are overblown, and that right now Air Products is trading at a very attractive multiple relative to its history, relative to the sector, and also relative to Linde.
And Jason, I also want to get your take on small caps. Now, we've been talking to some folks for a while now that like small caps, and they just haven't really delivered, I guess in part because we have not gotten the rate cuts that people were initially looking for. Do we need them to happen for small caps to catch up?
You do, and I think it goes back to the point of why people are investing with protection is sometimes they're early, and if you're early, you're wrong. And just as you pointed out, Julie, and people have been bullish on small caps for the last 2 years. When you look from a valuation perspective, they look quite attractive. There's a lot of reports out there that say that they're 20% undervalued historically to large caps. And I think that if you start to see a pullback or a rotation out of those, mega cap, the Magnificent Seven companies, you could see that capital allocated to small caps because of lower interest rates, and obviously small caps would benefit from that. But small caps also benefit from a strong dollar, which we're still seeing, and I continue to believe we'll see, and they benefit from a strong economy. So it's not just lower interest rates, although that will certainly be a tailwind for the sector as well.
Guys, thanks a lot. Really appreciate it, Michael and Jason. Have a great one.
Thank you for having us.
Thanks for having me.
Well, the meme stock trade has been back in focus, and now the Wall Street Journal is reporting that E-Trade is considering taking Keith Gill off the platform. The trader known as Deep Effing Value, I think we can call him here, who, of course, as we've been talking about, had posted or someone purporting to be him, we haven't confirmed it is him, has purported to show a rather large position of 5 million shares, including some options trades in GameStop. And apparently, according to the Journal, there has been this debate going on internally at Morgan Stanley, which owns E-Trade, about concerns as the Securities and Exchange Commission, also according to this story, is looking into his options trade. And because people follow him, is this considered market manipulation? You asked Chris Murphy about this earlier. So there's that concern on the one hand. On the other hand, there's a concern of what happens reputationally, what happens with his so-called meme army if they do take him off the platform. So they've been trying to sort of weigh those various elements.
Yeah, he does. I mean, to your point, I mean, listen, we've talked, he is a focal point of a lot of discussion. Millions of people watch Mr. Gill closely. They monitor him, they follow him. Followers on X. He has, just on that platform, he has more than 1 million. It sounds like, according to the Journal, Julie, the debate about him kind of as a client inside Morgan Stanley, they started kind of talking about this, according to the Journal, a few weeks ago. No decision has been made, and obviously the firm could decide to take no action at all, but worth monitoring.
Indeed, as we continue to monitor this story. And as you mentioned, 1.4 million followers on X alone. His last post, an Uno card. While we're wrapping up today's Market Domination, don't go anywhere. We'll continue following all the action after the closing bell. Stay tuned for Market Domination Overtime. There is the closing bell on Wall Street, and now it is Market Domination Overtime. We are joined by Jared Blickery today. He's down at the New York Stock Exchange. He's going to give us an update there from from there in a moment. But let's see where the major averages ended up first of all. The Dow off the lows of the session, down about 115 points, about 0.4%. We got more economic data coming out this week, but today we did have a measure of manufacturing that came in weaker than expected. So interesting action on the back of that because we got a mixed picture. The S&P 500 up about 0.1%, and the Nasdaq rising about 0.5%. So the S&P turning around late in the session. There are a couple other asset classes to mention before we take it to Jared. We have the 10-year having its biggest move of the year, I believe, down 11 basis points to 4.4% today, but that's not giving that much relief to stocks, interestingly enough. And then we also earlier talked about what's going on in the oil market. Big move there as well, downward, just above $74 a barrel after the OPEC Plus meeting that happened over the weekend that Ari Nesfaret told us about earlier in the day. Now let's send it over to Jared at the New York Stock Exchange for a closer look at today's sector action and the other noise that was happening down there.
Oh, it's a new set of noise. Nice to hear the closing auction here and a lively closing bell as well. Let's go to the Wi-Fi Interactive here. I'm going to chart the day's sector action. And as you noted, Julie, it was a worse day for bond yields. That means they went down the most for the year, but that's actually usually good for equities. Just not seeing it today. So in the forefront, we got healthcare. XLV is up the most. That's up 0.7%, followed by communication services and tech. Everything else in the red, led to the downside by energy. XLE down 2.64%. Also, I'd note that industrials and utilities down over 1%. And let's check out the Nasdaq 100, and then I'll get to the pharma sector. Decent amount of green here. And guess what? If we check out the NVIDIA chart,
all right, some technical difficulties with Jared. Let's get to Yahoo Finance. Miles Udland, though, got him here right on set. He's going to join us more on trading takeaways with Miles.
Jared was just warming me up to walk through some of my talking points. All right, let's start with the meme in the room, right?
Let's do it.
I think that it's like kind of cute, 3 weeks ago when this comes back up. It's been a few years. It's sort of like, let's go back in time and remember the meme trade. Today, you guys are just talking about the headlines coming over with the Wall Street Journal about SEC looking into this, E-Trade thinking about what to do about this. And I think you get into this moment where there's a large group of investors who are just going to be like, I don't want to hear about this anymore. I don't care. It doesn't matter to me. I don't play these names. And that's fine. And I think that, on the business media side of it, it's a very alluring story. There's still a lot of unanswered questions. It's a great story.
Personalities.
Right, great personalities. Yep. They've already made the movie. So, we can go through that. But I think, as we were discussing a little bit earlier, this is a feature now of markets. And not only the meme trade, but the retail investors' presence in shaping how certain kinds of big money managers will think about the market. For a lot of people, this is an opportunity to play it, I think probably on the long side as much as the short side. Obviously, when any stock goes up a lot, you've got plenty of shorts who are going to circle that idea. The short interest around a lot of these meme names, GameStop, AMC, others, is not, has remained considerable over the last few years. It's not like people have completely lost interest in these stocks as, call them sort of playthings of investors. And while it can be sort of, it's not a cute Groundhog Day anymore, right? It's a little bit like tired. And it's 2024. We're still doing this. But there is something notable about the role that, let's call them gags, retail-focused gags play in financial markets. We now have crypto available to go into 401ks. That whole market's kind of a, it's kind of a bit. It's kind of a fourth wall breaking joke, right?
Well, what's sort of interesting to me about this is, yes, whatever the subject of his trading is, like you look at what Keith Gill is doing. And I think about lots of other famous money managers who file 13Fs, who go on TV, and who people follow what they're doing, who speak at the Sohn conference, and people then chase those various trades. And so it's interesting to me that now there is someone outside of the traditional, and this was part of the narrative in 2021, of course, but now that he's that guy and he can just say this and then, the stock goes up.
The first part makes me think of the idea that, I don't know exactly what kind of numbers Buffett's put around it, but he said things to the effect of if I managed way less money, I would do way better, right? Because no one would know that it's him doing it. There's plenty of opportunities out there. I think this is why, long-only portfolio managers still exist. People are it's not I'm just not saying this, like there are lots of stocks that are going to outperform the market. In what proportion do you hold them? Do you identify them, and so on and so forth? That's why this business is so alluring for so many. But to your second point about how people follow all these individuals, I think that the meme stock trade has brought up like a fourth wall. I mean, I know I just said it, but there's a reflexivity around the awareness of. So I follow Keith Gill, therefore other people will follow them. Therefore I can short those people. Therefore I can go long against the people shorting him. There's this very meta, it's like a meta around where the meme stock fits into investor psychology. And the Reddit aspect of it, the social trading aspect of it, all these things that get very buzzy but are meaningful parts of the story, I do think bring in some unique elements to it where it is not just hey, this stuff always happens in financial markets. I think something a little bit different is happening with this specific kind of trade, and I don't think this is the last time we're going to be talking about GameStop, and probably not the last meme stock we'll ever find.
What did you think? We were also talking Chris Murphy from Susquehanna earlier, Miles, and he was kind of pointing out some differences between now and 2021. And one point he made, which is a good one, is that 2021 there was that kind of mania because it was always like, okay, who's going to get it next? You know what I mean? Who's got the bullseye in their back next? Whereas this time, Chris was pointing out, it seems more contained.
Yeah, there's definitely the field of potential meme stocks has been contained, to use his word. And I think the other part of it is, remember in 2021, it was like very, I don't know, cutting edge or whatever, but the first time someone came out and said, these companies should issue stock. The stock went up a lot, you should do something with it. Right. And, I remember certain commentators going on certain networks hammering the CFO of these companies every day. And I was like, hey, that is a good point. They probably should raise capital. And now guess what GameStop did last week? They went out and they raised capital. Yeah. And it's the very cynical side of this. And it's like, yeah, of course they're going to do that. And so to that point, Josh, I think the field is narrower because that's dilute of the shareholders. So why would you go trying to find the next meme name when you're just going to get diluted the second it quote unquote works? So it changes the nature of that trade a little bit.
And then I guess one of your other takeaways, although less fun to talk about, is but important, probably more important.
Maybe more important, probably.
Probably a little more important.
Let's bring ourselves back to reality.
The big drop in bond yields today that, as we keep talking about, did not give a meaningful lift to stocks, because if yields are going down because the economy is slowing down, that's not maybe so great.
Yeah, the last, let's call it 2 weeks of Wall Street notes feels like there's been just a lot more conversation around what's happening, specifically in the Treasury market. And I think viewing Treasuries as an anticipatory mechanism around what the Fed is going to do. We're going to get, a new dot plot next Wednesday. So that's coming up extremely quickly, where the Fed sees itself headed. And then, the PMIs that we got earlier this morning open up that question of just how healthy is the U.S. economy. A couple ways to read the retailer comments we've gotten in the last few weeks, but certainly enough critical mass around retail executives saying they see some signs of concern. So you've got that slowdown in the economy, you got where are rates headed, are they headed that direction for the right reasons? And, then that brings me back to this is one of the months of the year, you're in a little bit of a news vacuum. And so, you start looking at the other thing versus the other thing. Yeah. 6 weeks till we have earnings again. So we'll get through the Fed, and then it's 3 weeks of, kind of looking at each other as we get through
fingers crossed for
high school graduation and stuff like this, and send the kids off to camp, and then we will do bank earnings on July 11th or 12th.
Dads and grads, baby.
That's it.
That's June.
This is the time of year, let's break out your polos and the grill. That's it.
You're on it. You're very on theme. Thanks a lot, Miles. All right, meantime, it was also a busy day in the chip space. NVIDIA and AMD both making announcements at a conference in Taiwan called Computex. NVIDIA CEO Jensen Huang revealing details about the company's next generation chip platform, I guess you could say, while AMD launched its new AI processor. Joining us now is John Vinh, KeyBanc Capital Markets Equity Research Analyst. John, great to see you again. So how do we weigh all of these announcements? NVIDIA not giving us a lot of detail on what they're calling Rubin, which is what's going to follow Blackwell. But the market seemed to greet that announcement, though, better than it did anything we got from some of the other chip makers.
Yeah, I think the market was kind of focused on a couple things with NVIDIA here. Obviously, they have committed to coming out with an annual kind of product cadence in terms of releasing new GPU architectures, right? So Rubin was kind of very much in line with it, right? So you've got Blackwell ramps at the end of this year. Next year, they also announced Blackwell Ultra, and then you've got Rubin in 2026. But I think the the most important thing that investors have really been kind of keying in and focusing on with NVIDIA is this whole shift to this whole full server system stack platform, starting with GB200 and VL72, right? So NVIDIA is going to be shifting from shipping chips and boards to their customers to basically now shipping, full server rack systems with networking CPUs and GPUs all integrated into one hardware stack.
John, just to push a bit more on Rubin, I know maybe details were a bit scant, but what did we learn, John? What do we know about Rubin?
We didn't hear a whole lot about Rubin, but I think if you look at NVIDIA's historical cadence, each of their next generations of chips are going to use, two different things. You typically have a pretty substantial performance improvement, typically 40 to 50% performance improvement. And then increasingly, they are also shifting to, higher performance, high bandwidth memory. So, Blackwell is coming out, which is going to use HBM3E. It's likely that Rubin's going to use the next generation high bandwidth memory called HBM4.
John, what we all kind of keep trying to get our arms around is how long can NVIDIA continue this pace? And I know that you have on the street relatively high expectations going forward. We talked to one analyst this morning who said that the market cap for NVIDIA could exceed $10 trillion by 2030. Does that make sense to you? Do you think we're going to continue this pace?
I think NVIDIA has an extremely bright path ahead of itself, right? We're in the very early stages of the generative AI cycle. And, like a lot of chip companies, you get into this cadence where they're just releasing, version 2.0, version 3.0, which are just, slightly better versions of, version 1.0. But if you look at what NVIDIA is really doing, they're really still taking really substantial shifts in architectures, right? They've gone from making chips to kind of integrated, AI board solutions to now fully integrated kind of heterogeneous compute server stacks, which is, allowing them to kind of maintain their leadership above their competitors.
And John, AMD made some news here too. I'm interested to get your kind of take broadly, John. CEO Lisa Su, can she kind of effectively compete here, in your opinion, John? Can she keep up with Jensen Huang?
I think she can. The question is, for AMD to win, right? They don't have to get 70 to 80% market share, right? But she's has a phenomenal track record of executing on the PC front with Ryzen. On the server front, they've been able to go from almost zero share, and now they've got close to 30% share of the server market versus Intel. So she's got a great track record of execution there. She's also got a very strong customer base within the data center, which she's using as a foothold to get to launch their AI chips MI300X. So yes, I think she can compete. I think she's got a great track record. I also think that the market is really badly looking for a credible second source to NVIDIA. NVIDIA is making 90% gross margins on its AI chips, which is unheard of in the chip industry. Those are like software margins. And the industry badly wants a credible second source on the merchant side.
John, switching gears, before you go, I just want to get your reaction because there was a surprise leadership change at Lattice Semiconductor. The CEO, Jim Anderson, leaving the company and going over to Coherent. What do you make of that, and where does that leave Lattice?
Yeah, we certainly were surprised by that announcement. Jim Anderson has been, credited in our view for a big part of the turnaround story at Lattice. Coming in, identifying that this was a really, highly valuable asset, and making changes within the company, and also bringing in a very strong management team. He also has a very strong track record. Come from AMD, is largely responsible for a lot of the success of Ryzen. So, we're a little bit concerned, because if you look at Lattice, we think they've got very bright prospects ahead of themselves. They're gaining share within the small FPGA market. They're also launching their mid-range Avant product, which is basically going to double their TAM. So, with that kind of ahead of themselves, we're surprised that he kind of left for Coherent at this point.
Yeah, well, we'll keep an eye on it to see who ends up running Lattice on a more permanent basis. John, thanks so much. Good to see you.
Thank you for having me.
Well, a big name from the meme stock craze of 2021 has taken up a short position on GameStop again. More on the meme mania when market domination over time returns. A check-in on the crypto landscape. MicroStrategy's Michael Saylor has settled a tax fraud lawsuit with the District of Columbia. The Bitcoin investor agreeing to pay $40 million to settle the case. The complaint alleging Saylor violated the district's tax laws by not paying income taxes while living in D.C.
Meanwhile, Binance founder CZ reporting to a federal prison in California. He will be serving his 4-month sentence in a low-security facility after pleading guilty in April to charges of enabling money laundering. As for FTX co-founder Sam Bankman-Fried, the 32-year-old making it back to the Metropolitan Detention Center in Brooklyn after briefly going to prisons in Oklahoma and Pennsylvania last month. Bankman-Fried will remain in the city until his appeal has been fully briefed.
And GameStop shares surging as retail traders pile in after Keith Gill, also known as Roaring Kitty, showed a position in the video game retailer, a rather large one. One meme frenzy critic, however, taking this as a chance to re-short the stock. Andrew Left, Citron Research founder, joining us now to discuss. Andrew, first of all, it's good to see you again. I hope you're doing well. I thought you hung this up. I thought you weren't going to do this anymore, that you had given up shorting these guys.
I find it amazing. I can't believe it's 3.5 years later we're still talking about GameStop.
I can't either. So what drew you back in? Every time you try to leave, they pull you back in. What
I woke
happened?
up this morning. I wake up this morning, I've traded the stock small, but I wake up this morning, I see where it's trading, and you see why it's trading there. And so much is wrong. See, the first time, going back 3.5 years, I kind of understand what it is. There was a high short interest in the stock. It became some global movement, the eat the rich. He became a folk hero, this roaring kitty. He put an actual thesis up. He made a video online why he thought GameStop was undervalued. And he actually put an investment thesis, albeit he was wrong. It went higher. And the rest is folklore. Today was totally different. We wake up today, and all of a sudden last night, he puts this monster position, no thesis. He's been wrong. Short-term options. I personally do not believe this is his own personal money.
Why do you say that, Andrew?
I mean, just let's do math. I mean, what's the size of this trade that he put on today? 150 million?
115, something like that?
Okay, let's say it's 150 million. How much did he make first time around? If he made, 200 million after taxes, you have 100 million. Do you think he put his whole net worth on this trade? If he made 250 million, I don't think he made 250 million. If you go online, it says he made somewhere around 50 million, 60 million. So I just don't think it's his money, and there should be some form of disclosure if it's not, that he's went out there to really shake this world up. And also, he didn't give us a thesis. It's not like he said, I'm buying it for a reason. So either he has MNPI, and I don't think he does. Fair enough. I don't think there's anything GameStop is going to say in the next 2 weeks. I mean, what are they going to say? They're opening an AI fund with the money they raised. It just seems to me it was completely different. It was almost like what he's doing right now is trying to take advantage of the retail traders, the same people that he was supposed to represent 3.5 years ago.
So, Andrew, what are you doing this time around? What position have you taken?
Well, first of all, whenever I short GameStop stock now, you do it cautiously, and you do it prudent. You understand. I think everyone learned, any trader learned 3.5 years ago that anything can happen. And the last thing you want to say is it's different this time, but I think it's different this time. Namely, you don't have the same short interest you had in it. And we've seen the capital structure of the company is different, and people have seen how it's played out more. So yes, obviously, I think if given the opportunity to short the stock when it was $40 this morning, it's great. I think if somebody, I don't recommend people short stocks, but I think anyone who's buying the stock right now, I think it's going to be short term. I think they won't have any patience for the kitty's nonsense.
Do you, Andrew, I'm just curious, what do you think GameStop's future is as a company? Do you even think of it as a company?
Well, I mean, Ryan Cohen doesn't even. They pretty much almost abandoned their strategy, right? He wants to use the money in the corporate coffers to go ahead and do outside investments. So I think they've taken the whole notion of, what GameStop could be, and it's gone. Think of the different iterations it's had in the past 3 years. It was going to be something in the crypto space. It was going to do something, that didn't go. Obviously, the GameStop didn't work. The streaming didn't work. Partnerships don't work. And now it's just going to be an investing vehicle for Ryan Cohen. So, the future of GameStop is, what am I going to say? Also, the GameStop token rallied today. So right. I would have never guessed even that there would be a GameStop token. So.
And just quickly here, there was also a report that E-Trade was considering removing his account from the platform. What's your reaction to that?
I think it's awkward to post. You're talking to me. I believe that people should put their opinions online. If you believe in your opinion of the stock, put it online. To post your actual account without anything behind it, it just seems something about it seems wrong. And I guess I can't pick out what it is. I guess E-Trade felt the same way. If in fact they do this, if in fact this is his account, right. If in fact a lot of different things.
There's a lot of ifs. Oh, finally, Andrew, the last time this happened and you shorted the stock, I seem to recall you got threats, right? You got a lot of flack, and that's why you kind of pulled back. You felt like you perhaps weren't safe as a result of all this. Are you worried about this time? As you said, this feels different.
It just feels different. First of all, it's not a jihad against GameStop. I think people understand. It's amazing. I think investors understand now differently. I think people are not. We've changed a lot, and I think the retail mentality has changed a lot. I still think people are incredibly mean online. I still think Reddit and Twitter or X is a real mean place. A lot of times that I don't enjoy even reading about. I'm just, giving fair market commentary. So I haven't looked at my emails. I kind of won't read Twitter or Reddit, what they say about me. I really don't care. I just hope the retail investors realize right now, this is not what we saw 3.5 years ago. I really don't care if they don't. If someone wants to buy the stock at 30, 35, if the stock goes to 50, it goes to 50. So, goes to 80, goes to 80. So I lose money. It's an open free market.
It is indeed. Andrew, thank you so much for talking to us. It's good to see you again.
Thank you.
Thanks. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered with the latest and greatest market-moving stories. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, I'm going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Meme stocks reignited. A Reddit post reportedly from meme stock leader Keith Gill sparks a wide-ranging rally, but the Wall Street Journal reporting that E-Trade is considering removing him from the platform. Plus, concerning. That's how the head of the NSA describes cyber threats from China hackers. In an interview with the Wall Street Journal, we're going to be talking about the state of cybersecurity with Zscaler's CEO. That's coming up next. And major investments in AI mean a major uptick in energy use. And as a result, more carbon dioxide released into our atmosphere. We're taking stock of the carbon removal landscape in our latest edition of Next. Zscaler reporting a strong third quarter on the top and bottom lines last week. The company also boosted its fiscal year guidance against the backdrop of more cautious guidance from peers in the cybersecurity sector. For more, we're now bringing in Zscaler CEO Jay Chaudhry. Jay, it is good to have you on the show. And, Jay, this is the first time we've had a chance to talk to you since you reported results, Jay. You reported, you beat, the stock jumped. Maybe start there, Jay. Walk us through what drove the quarter.
So, cyber is a number one concern for CIOs, CISOs, and boards, but they also have to worry about cost savings. Market is tight, there's a lot of deal scrutiny. Zscaler is a unique provider where we provide the best cybersecurity with zero trust architecture, but we also reduce cost because we eliminate a bunch of legacy security point products, firewalls, VPNs, and more. So that's why we're able to close business by doing both at the same time.
Hey, Jay, it's Julie here. It's good to see you. You guys recently reported a cyber breach, I believe. What can you tell us about that? And did that have any kind of effect in the quarter or in the present quarter?
So there's no breach per se. There's a claimed breach, so to speak.
Gotcha.
The social media can do all kinds of stuff. Yes, we did have an engineer trying to play with a new server in a QA environment, single machine. That was out there discovered, that was being set up. So there's a little basis for it. There's none to it. We're very transparent with customers. We kept in communication, but it had no impact. Rather, customers came and said, wow, you guys had great, transparent communication. We love it.
Jay, when we have you, it's always worth getting your kind of broader take on the threat landscape, Jay. I mean, a lot of threats, rogue states, bad actors, criminal gangs. What are you seeing out there, Jay?
There are two main areas. One, the people who want to make money quick, so ransomware on the rise. And then there are nation states trying to steal secrets. Those are the two big buckets. And they are leveraging by getting on the network of the company, moving laterally, find high value assets, and going after them. So zero trust architecture is being really looked at as the primary solution for it. The reason Zscaler growth is happening is because companies are embracing zero trust architecture that we pioneered. You talked about China just now. The big threat from China is that all large companies who are present in China, they have a network coming from China all the way to the US or Europe. Bad guys can get on the network in China, travel, and try to infect stuff out there. We allow you not to have a network connected to China or other countries and still have secure communication. Those are the type of things enterprises and federal government organizations need to do to secure themselves.
And Jay, of course, this is an election year not only in the U.S., we just had an election in Mexico, we just had an election in India. And I know that when you're talking about breaches or insecure communications, that's a very different issue than misinformation and disinformation.
Yes.
But I'm just curious what you are seeing, if anything, sort of linked to geopolitics around the globe.
So we do track it, though it's not our primary focus. We are seeing uptick of misinformation. We have a research team that actually tries to figure out what content is generated by Gen AI and what content is created by people. It's fascinating to see you can actually tell the difference. And we're seeing a lot more content that's being put out there that Gen AI is creating. So all of us have to need to worry about it.
Jay, I want to touch on competition real quickly, and specifically Microsoft moving into your world. I was checking with an analyst, Jay, who covers the company, and he was saying, listen, that is, in his opinion, creating some noise in the market and on the street. What are you seeing, Jay?
Look, large companies like Microsoft, they want to expand in all areas, right? So I'm not surprised that they're trying to expand in our area. They have had overlapping products for a while. Microsoft Windows has VPN built in for a long, long time. But when I talk to large enterprises, they ask for two things. Number one, they said, I want a security provider like a Switzerland who can equally support my security to access Office 365, Azure, AWS, GCP, and scores of SaaS applications. we are in a better position to do that than an application provider like Microsoft. Number two, with all the issue you're seeing out there with Midnight Blizzard, I'm sure you saw the report that came from federal government about some of those issues. More and more customers want application provider to be different from security provider. Separation of applications and security is a better thing. You don't want a fox watch the hen house.
Jay, we always appreciate you coming on the show. Thank you.
Josh and Julie, thank you for the opportunity. Hope to talk to you again.
Up next, diving into the trend of carbon renewal in our latest edition of Next. More Asking for a Trend on the other side. The rapid advancement in AI has accelerated energy usage for tech companies. The surge has been so significant, the IEA recently warned energy consumption from data centers, AI, and crypto would likely double in the next few years. That's put the importance of carbon removal technologies in focus. Major tech companies are increasingly turning to the controversial process to offset carbon dioxide they can't reduce on their own. And one company is getting big backing from Meta, Alphabet, and JP Morgan. Akiko Fujita takes a closer look for the latest episode of Next.
So the first thing we're going to do is turn our spinner blades on. You can already see a streak where we've already spread out there.
Rick Bennett is a third-generation farmer trying his hand at a new type of fertilizer, crushed volcanic rock known as basalt. The rock dust is considered waste, but one startup is finding new use for it to tackle a climate crisis. Workers here affectionately call this brown mountain. Lithos Carbon considers it gold.
This material is what's chemically reacting with carbon dioxide to permanently capture and sequester it into a form that takes it out of the atmosphere.
It's a process that happens naturally over thousands of years. Lithos Carbon is spreading it on farms to accelerate it to 2 years, backed by a $57 million investment from Frontier, a consortium of companies that includes Meta and JP Morgan.
There are some portions of company emissions that you will just never abate. Recognizing that they have a net zero target and they want to actually get to zero and honor their very public commitments, they have to invest in some sort of removal technology.
Scientists say it's not enough to reduce carbon emissions, but capture them, with CO2 one of the leading causes of climate change, which is why hundreds of companies are pouring into the carbon removal space. The question is, which can scale up quickly, cheaply, with the future of our environment at stake? This is what's next in carbon removal.
We've got drill rigs prepping for the next shot. We've got blasters in here loading for a shot. This quarry is so busy, we blast a couple times a week out here, and that could drop 50 to 60,000 tons of rock at a time onto the ground.
How far down are we?
Right now, we're about 100 foot down in this active pit. State of North Carolina, we can mine down to 500 feet deep. So we're gonna be here a very long time mining this product.
This fight against climate change begins with one of the most abundant resources on the planet. Basalt has long been considered the building blocks used in asphalt and concrete. Sunrock Quarry in North Carolina has so much of it, it ships out millions of tons every year.
We take that 36-inch boulder and we crush it down to sand-sized particles that we can put into asphalt and concrete. And from that surge pile, it'll get crushed again, it'll get screened, it'll get washed, and it'll kind of continue on that process until it gets to a final product size and spec and stockpiled.
Sunrock uses every piece of that rock except the dust of waste that piles up in the end.
This is the secret sauce.
This is what we looked all over the country for, is this particular material.
Not all basalt is the quality that Lithos wants. Can you tell by just looking at it, or do you actually have to?
You can't, yeah. So we look at it under an electron microscope. We're looking at all the properties that make it suitable for the carbon capture process and also release the nutrients that helps the soil and the plants grow in it as well.
It's part of a process called enhanced rock weathering. Carbon dioxide in the atmosphere combines with rainwater to create a weak form of acid rain. When that rain hits volcanic rocks, it leads to a chemical reaction that traps CO2. It's a natural process that takes thousands of years. Lithos Carbon is speeding that up more than 1,000 times by spreading the finest form of rock dust across farm fields. The thinking is, the more surface area the rocks cover, the more carbon is captured. Lithos says all of the rain combined with basalt also helps improve crop yields.
Farms are extra special and extra powerful for a few reasons. One, the roots, they break up the rock dust faster, so that's great. Two, the farmers already need to spread rock dust in their fields. They need to do this to rehabilitate their soils after we use synthetic fertilizers. The farmers, they're already spreading rock dust, and we're actually replacing something they already do today with something that works even better. So it's plugging into existing infrastructure, piggybacking on that, and allowing us to scale this climate crisis faster.
So the drill goes in, it pulls the dirt right up into the bucket.
The soil is manually tested every 2 acres every 6 months to measure the amount of carbon captured. Enhanced rock weathering is one of many solutions in a growing industry with demand projected to quadruple from 2030 to 2040, according to consulting firm BCG. There are already more than 220 carbon removal companies globally.
There's multiple different pathways, chemical pathways for which you can take CO2 out of the air. And no one really knows for sure yet which ones are going to be able to scale the fastest and come down the price curve most effectively. And so it really starts to become a complicated puzzle of which technologies work in the right atmospheres or in the right environments to optimize all of this. And we need some of all of them.
This satellite image of carbon in the atmosphere points to the scale of the problem. Humans have dumped 2 trillion tons of CO2 into the air, pushing global temperatures more than 2 degrees above pre-industrial levels. The UN panel on climate change says we need to remove up to 10 billion tons per year by 2050 to avoid the worst impacts of climate change. That amounts to roughly 25% of annual carbon emissions today.
Most expect that many of those emissions will be eliminated through various reduction measures. So more efficient motors, cleaner power, et cetera. But there is still a large amount of emissions that ultimately will have to be taken out of the atmosphere in some way if we want to get to net zero.
That's where carbon removal comes in. Even with all of the efforts to decarbonize, BCG's current mystery estimates companies will still fall more than 30% short of their goal to be truly net zero. That means they'll need to buy carbon credits from companies like Lithos to offset emissions they can't reduce on their own.
I think all of these sort of front runners in the carbon market, they're not just interested in what they can buy today, they're investing in the future of the carbon dioxide removal market. The scale of the problem, they recognize that investment is needed. So they are looking to kind of support pathways.
There are a lot of ways to remove carbon, but there's a trade-off between affordability and reliability. Direct air capture has the simplest measuring system, but it requires building large factories that can suck CO2 out of the air. It costs up to $1,000 to capture a ton of carbon. Methods that rely on agricultural waste are considered cheaper, but it requires a lot of land. Enhanced rock weathering uses a smaller footprint, but critics say there's too much uncertainty. There isn't enough data to show how effective the process is. Planting trees may be economical, but Mystery says the carbon storage isn't as permanent. Precise measurements are harder to come by.
You can estimate how much carbon is in the tree, but there are questions like what happens if it gets cut down? What happens if there's a forest fire? And so in all of these technologies, they all have various pros and cons, but in general, the higher quality ones or the higher durability ones are the ones that are closer to I can touch and feel and I can see this much has been removed and someone can put a stamp on it. Another question related to that is what is the relative value or quality of the different credits, right? Buyers want to have confidence that they are purchasing actual carbon that's been removed. They don't want to purchase something and then find out they didn't actually remove on their behalf.
It's a big reason why companies with the most aggressive climate commitments are backing new technologies. BCG estimates this market could reach as high as $135 billion by 2040. BCG's invested its own money, signing partnerships with direct air capture companies like Climeworks to remove more than 140,000 tons of CO2 combined from the atmosphere. Companies from Alphabet to JP Morgan have invested more than $57 million in Lithos as part of a consortium known as Frontier. The funds agreed to buy 154,000 tons of carbon from Lithos in the next few years. Combined, Frontier's committed to buying nearly $1 billion of carbon by the end of the decade.
We are moving so much material that anything that we can do to optimize the movement of that helps. So part of these large offtake agreements, what they allow us to do is start leveraging more efficient methods of transportation like rail or like barge. Those methods can be extremely, extremely efficient, but you need to move a lot more minimum volume to get there.
Impact is still hard to quantify, though companies are required to measure and verify carbon credits that are sold.
One of the most important things is that clear MRV, the monitoring, reporting, and verification. If you can clearly articulate and prove that you have captured a ton when you say you've captured a ton.
But there's not a universal standard right now, correct?
That's correct. And it gets really tricky when you start to look at different technologies. With enhanced rock weathering, you take rocks, you scatter them, and these rocks will absorb CO2. And in these situations where you have the capture occurring over, it could be acres, it could be thousands of acres, you can't possibly measure every single rock, right? So how do you sample it and come up with an agreed upon number that is the removal that can then be sold?
Soil samples can point to the amount of CO2 captured on farms, but that carbon doesn't stay locked up until it makes its way to the ocean, where it's sealed off for good.
So what you actually measure here is not necessarily ultimately what becomes the credit.
That's correct. Yeah, this is sort of the initial step in the process, right? What we're measuring here is exactly how fast the rock is dissolving in the field, how much carbon dioxide that is pulling down, and then we look at all the downstream effects. We call it kind of like a cradle-to-grave accounting, right? So we look at the effects here, we look at what's happening in the rivers, we also even model what's happening in the oceans. We take all of that into account before we kind of say, hey, here's a ton of carbon that we've captured.
We're doing custom application here. We're actually applying basalt, the material here, for another farmer.
Farmers like Rick Bennett are keeping a close eye on their fields. Litho says the tiny rocks are helping improve crop yields by up to 57%. In addition to handling and paying for every step of the process, Lithos pays him. Farmers get $50 an acre as part of the program.
What's the result been from a yield perspective? Has it actually improved the quality of the soil? Has it improved your yield?
We have only had one season with it on the land. We truly, in our test, didn't see a yield increase last year, but we also did not lose any ground on our yield from the previous year. So we're excited to measure the results again this year. We think there'll be definitely a yield increase.
Lithos expects to capture up to 50,000 tons of CO2 on farms this year. Hundreds of other farmers are waiting to partner with the company, but they'll need to scale much more than that, with demand for carbon credits far outpacing existing supply in the market.
Our goal is in the next 3 to 4 years to get as much data as possible that allow us to go the full way. Models that will allow us to say, hey, we know the soil types, we know the crop types, we know the climate. We see ourselves building something like the Google Maps of enhanced weathering. From there, being able to scale down our measurement costs. They're really taking the whole lion's share of profits at the moment. Scale down those costs, reach more farmers faster, scale this up for society.
The need is so great, right? We are at the kiloton scale today. We need to get to the gigaton scale in the future. That is a factor of 1 million growth. Today, CDR is an optional thing, and it's starting to change, but until it becomes required, it's only going to be limited to those who are willing to do it voluntarily. The only way we can scale the technologies as fast as we need is if many of them succeed. So this isn't, I need DAC and not trees. This isn't, I need enhanced rock weathering and not biochar. This is, I need all of it, and I need all of them to scale.
The EU and the US have proposed guidelines to scrutinize the quality of carbon credits in the voluntary market. But Misri says mandating offsets are critical to bringing costs down, a necessary step to getting companies to their net zero goals. Lithos currently charges $370 a ton. The goal is to slash that to $100.
So our goal is to be capturing billions of tons of carbon dioxide using enhanced rock weathering. We know that's possible. Our goal is to really be at maybe 2 to 6 billion tons worldwide.
How many farms do you need to spread this across? How many acres do you need to cover to get to that goal?
It's not even all of the world's farming land. It's actually just a fraction of it. So in America, if we just focus alone on corn and soybean crops, and there's many other things we grow, obviously. But if we just focus on that alone, we believe we could capture up to 0.7 gigatons, so 700 million tons of carbon dioxide. So that's the key.
Time now for What to Watch Tuesday, June 4th. We're going to be getting the first look at the labor market this week ahead of Friday's jobs report. The latest JOLTS report for April is out at 10 a.m. Eastern. Economists forecasting job openings will decline from March, which was its lowest level in more than 3 years. On the earnings front, we're going to get results from CrowdStrike, PVH, and Stitch Fix. CrowdStrike announcing first quarter results after the close. Analysts expecting the company's annual recurring revenue growth to stay above 30%, driven by its add-on products. Also on deck, Hewlett-Packard Enterprise and Bath & Body Works. HPE reporting second quarter earnings after the bell tomorrow. According to analysts, the company is expected to deliver big gains from AI servers. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.